welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's your look at the stories for the day. Unseasonal rains slammed the brake on the Mercury's upward march and brought cheers to the people. But this weather wasn't pleasant for farmers as the helplessly watched rains ruin their standing wheat crop. Government too confirmed the worst fear this week that about 8 to 10% of the wheat crop has been damaged in key producing states of North and Central India. And about 80% of the new crop that has reached procurement centers is subpar. So how serious is this situation? Tushar Verma's report has the answer.
Unseasonal rains, hailstorm and strong velocity winds have reportedly damaged wheat crops across more than 5.23 lakh hectare in Madhya Pradesh, Rajasthan and Uttar Pradesh. And nearly 80% of the new crop that has arrived at the mandis in North and Central India so far in the last few weeks is low grade. The recently harvested wheat is fetching prices in the range of Rs 1,900 to 2,050 per quintal. It is much below the minimum support price of 2,125 per quintal fixed for 2023 to 24. A key reason for the low quality of wheat at the mandis is the high moisture content. This is expected to decrease since the upcoming months will see high temperatures. Let us hear what experts have to say about the damage.
There will be damage both in terms of yield or quantity as well as quality, because plenty of wheat crop is still standing in the fields, especially in Punjab, Haryana. It's not harvested. So there are all reports that from that area that the yield may also go down because of the crop falling flat in some areas. They have a difficulty in harvesting, and it will not be collected fully when combine harvesting is done. But definitely there will be quality loss. The quality of grain will not be same. It happened last year also. For different reason, it was more because of excessive heat. But this time because of excessive rain, there will be maybe, I expect that maybe between 10 and 20% yield loss.
The wheat output in the country is likely to be affected due to this. The Ministry of Agriculture in February 2023 had projected an output of 112.2 million MT for FY23. However, our S&P Global Trade Survey put the projection between 107 to 108 million MT. This is still higher than last year's harvest, which was 102 million MT.
Compared to last year, but in terms of expected, because I think the government does this assessment 4 times in a year. So it may be the yield loss may be 10 to 15% maximum, because in some areas like Madhya Pradesh is already harvested. But it's in Punjab, Haryana, which is also a very significant part of the wheat growing area. So there it will be, I think, lower by about maybe 10%, 10, 15%, not higher than that. That's sort of my assessment. Yeah. So to that extent, yes, wheat production may be a bit lower than the expected.
A dip in wheat yield is likely to push the inflation further. India's inflation is driven by cereals. As of February 2023, the cereal inflation was 16.73%. This is a decade of high inflation in cereals.
In terms of food inflation, we're looking at, if we were to look at the weights in the food index, from milk to cereals, all of them appear to be on the higher trajectory. In case of wheat, we know, of course, the global market is down, but our own FCI stock levels are low, and therefore, and with the new crop, if the damage is there, then we are looking at inflation in wheat continuing to sustain.
Farmers, of course, will be the most affected. Experts say that if such a scenario persists, farmers may not even be able to recover their production cost.
As for farmers' income, of course, we know that higher prices improves the value realization, but clearly here, two bigger impacts. One, the yields are lower, and therefore the quantity they'd be able to produce and sell would be lower. And second, the costs are going to rise, because in case the crop which is standing and ready to harvest gets wet, we are looking at and the crop falls. So then we do not anticipate the use of harvester in combined harvester in harvesting the crop, and therefore you'd need labor. And of course, labor costs in Punjab and MP are high, and therefore we are looking at higher costs impacting the farmers' income. In case of Punjab, particularly, we see this is the fourth year in the running where they will be suffering such losses.
Farmers who lose their crop, even if it's 10 or 15% or 20%, that is going to be very difficult for them to make up for, because in some states like Punjab, there is not even a crop insurance scheme. So the state government trying to give them 15,000 rupees per acre only if they have lost up to 70% or higher of the total production. So those who lose less than that will get only maybe 5 or 6,000 rupees per acre, which doesn't even recover their total cost of production.
But all is not lost. Wheat crop is yet to be harvested in vast swathes, and as the clouds give way to bright sun and to hotter days, the yield will improve. IMD in its latest forecast said that temperatures will start increasing from mid-April. However, they will not lead to heat waves. The next few days will clear the picture on the actual impact of damaged wheat crops.
High inflation and low returns have nudged people to look beyond the traditional investment options like fixed deposits. The number of retail investors in India has risen at a breakneck speed in the last 2 years. Experts also credit discount brokerages for this. In our next report, Raghav Agarwal tells how these brokerages have changed the trading game in India.
In the past few years, the number of retail investors in Indian equity markets has seen a sharp jump. The rise has been steeper since the outbreak of COVID-19 pandemic in 2020. Market data shows, as of December 2019, India had 39.4 million demat accounts. By August 2022, this had crossed 100 million, and as of January this year, the number had risen to 110 million. This is a jump of nearly 180% in just over 2 years. Much of this has been credited to the success of discount brokerages in India. These brokerages, which carry out a trade on behalf of the investor at little or zero commission, have made trading easier for retail investors in India. Data from NSE shows that in January this year, the 5 discount brokers, namely Zerodha, Angel One, Grow, ICICI Securities and IIFL Securities, accounted for 59.2% of the overall active clients, and they are reporting profits. According to a report by HDFC Securities, Zerodha, the largest stockbroker in India, is expected to make a profit of 2,500 crore rupees in 2022-23. In 2021-22, the unicorn's profit was 2,094 crore rupees. These numbers are impressively high compared to the traditional brokers in India. So, how have they changed the trading game in India? Utkarsh Sinha, managing director of Bexley Advisors, says discount brokerages cater to the rising needs of investment avenues of retail investors in the country.
The disruption in the brokerage industry globally that it has been brought about by discount brokerage shops has been a function of the fact that there is finally an ability to meet the demand of the retail investors, which are of a much lower fidelity and of a much lower, servicing quality than for traditional, customers of brokerage houses. A traditional customer would need a speed of execution, would need some certain confidentiality requirements, would need to make sure that there's no front running. There's the need to make sure that there's some a certain level of regulatory compliance, and that their clients' interests are met. When it comes to a retail investor, the bar for each of these dimensions is significantly lower. And the only reason that these individuals could not be serviced earlier was because the technology was not in place. With the advent of internet, with the advent of apps, it was a lot easier to aggregate large scale demand which from retail investors, and therefore that led fundamentally to the rise of the discount brokerage industry.
Arun Kejriwal, the founder of Kejriwal Research and Investment Services, says discount brokerages use technology to lower costs, which allowed them to cut commissions and book higher profits.
These discount brokerage houses offered a online platform. They had much lower costs because they didn't need huge amount of manpower. They were all system driven, and hence they were able to cut down on manpower costs. This changed the way broking happened in the country. It is this which allowed them to offer cheaper prices.
Sinha of Bexley Advisors says the flow of easy money was also a major reason in the jump in profits of these discount brokerages.
The other key factor that has played a role in its significant acceleration in the past 2 or 3 years has been the availability of cheap money, particularly during the COVID lockdown. There was a lot of stimulus spending that happened globally, and part of that, and the amount of savings that individuals had went up because a lot of the expenditures that they had in traditional categories went down. The combination of these factors led to the fact that there was surplus capital available with retail investors who were looking for avenues to invest it, and discount brokerages gave many of these individuals an opportunity to dabble with the markets.
A large number of trades on discount brokerage platforms are in futures and options. Kejriwal believes these brokerages might see a fall in activity in the coming months as investors have started to face losses in F&O trading of late.
A lot of them migrated from equity to futures and then to writing call options. They have lost a huge amount of money in recent times because money cannot be made part-time and doing these high-risk games. They have now started leaving the market. So it's now a full circle back to zero.
Sinha believes the tightening monetary policy of the RBI will also have an impact on these brokerages.
In terms of the long-term future of such classes, I think as soon as the ease of money flow starts drying up a little bit, as soon as the interest rate regime changes, and it has already started changing, we will see a drying up of excess capital in the hands of the retail investor, and the effect of that is going to be somewhat slowdown of the discount brokerage industry. I think we should expect to see that happen, globally and in India as well.
Traditional brokerages are also focusing on digital expansion, but not without improving their offline reach.
The focus is surely on digital in a very big way, and at the same time, we have also opened new branches in the last 2-3 years to build our physical presence, because we feel that when a customer who has got wealth and wants to invest, he would also like to be in touch with the advisor, may want to visit the offices. So we have got a very good presence digitally, and we have got a very big franchise network, which itself has its own offices across the country.
The discount brokerages have made trade easier for retail investors in India by providing easy access to markets using technology. This has also helped them beat traditional brokers in terms of profits as well as the number of investors. In the coming days, however, they may witness a dip in revenue and profits.
India Inc. meanwhile will kickstart the January-March quarter earnings season from next week. Analysts believe that a fall in commodity costs, pickup in credit growth and easing supply snags are likely to help India Inc.'s margins. So what should investors expect from Q4 FY23 results? Lavisha Darad's report has the answer.
Tata Consultancy Services will start the Q4 FY23 earnings season next week. This will be followed by results of Infosys, HCL Technologies, HDFC Bank, ICICI Bank, among others. According to a Bloomberg estimate, Nifty EPS is likely to grow 3.2% quarter-on-quarter in Q4 FY23E, while Nifty EPS grew 15% quarter-on-quarter in Q3 FY23. It saw degrowth of 12% quarter-on-quarter in Q2 FY23. Analysts expect Q4 to be a mixed bag, with banks, hospitality, aviation, and cement companies to report good numbers.
We expect the markets to be volatile in the near term, driven by two key factors. One is the earnings growth expectation for Q4 FY23. And the second one is what happens with the banking sector in US and Europe. Are there any more dominoes to fall in those regions? Especially with the earnings season in India, we expect banks to perform well with 15% plus credit growth, margins being stable, and no major hit on an M2M basis on their debt books. Um, for consumer discretionary names, we expect the earnings to be weak, uh, led by very slow demand from end consumer and inflationary pressures on raw material side. FMCG too should see lower consumption growth, especially in the rural areas. One segment in the consumer discretionary space which is expected to do extremely well is travel and tourism. We expect hotel industry to do very well. Apart from that, we also expect airlines to do well, also helped by lower crude oil and thus ATF prices. Another sector which should do well in terms of volumes and costing is cement. Volume growth should be in double digits, while on costing side, on the fuel and the power side, we expect lower cost QOQ, which will help EBITDA per ton improvement of close to 150 to 200 rupees per ton. We've not seen any major increase in pricing. In fact, the pricing could be slightly weaker QOQ for cement players. But overall, we expect cement players to do well in this quarter. In pharma, we expect domestic pharma players to witness mid-single digit growth, while international or US business growth will come from G-Level for a few players, while pricing pressure across other products continue.
In Q3 FY23, the combined interest expenses of 888 listed companies rose nearly 31% year-on-year, whereas net profit of these companies declined 13% year-on-year, showed an analysis by Business Standard. From an investment perspective, analysts see auto ancillaries and manufacturing stocks as good bets on hopes of margin recovery in Q4.
Going into the result season, markets are light, positions are not exceedingly bullish, and that's fodder for rally which can occur. From a sectoral perspective and from an overall earnings perspective, the earnings season could be a more mixed bag. We are still seeing downgrades and lower earnings happening for commodity sector, and overall we believe that that trend could continue. Even in FY24, we'll see moderation from the sky high strong earnings growth that commodities saw last year, and that moderation could continue. BFSI had a strong purple patch. It has performed very well, and we believe that even in this quarter, we would see strong numbers from lenders, particularly, and that will translate to strong earnings growth. Thirdly, we've seen that margin seems to be bottoming out, especially for commodity users, specifically in case of auto ancillary sectors and selective manufacturing in brown and white goods sector. We are seeing that margins may be bottoming out, and this could protect earnings growth for some of these sectors. IT again is one sector where we are seeing divergence. Valuations are still expensive. Secondly, we are seeing IT companies have still shown a very strong divergence in wage growth for their employees, and which is sending out mixed signals overall. This sector is still likely to be in consolidation. The result season could be very, very important from a perspective of how this sector behaves going ahead. All in all, we believe that markets are still expecting 15 to 18% growth in FY24. The last quarter result for FY23 could be crucial in setting the tone. We believe the markets are slightly over optimistic. Our estimates suggest that we should clock in an earnings growth of about 12% in FY24, which itself is good enough for index to see a recovery.
Overall, analysts foresee markets to remain volatile ahead of the Q4 FY23 growth expectations and recommend investors remain selective. Today, markets will react to the RBI's monetary policy decision. Experts expect the central bank to raise rates by 25 basis points. Besides, global cues, foreign flows, and crude oil prices will continue to dominate market trends.
the markets theme, the shares of automotive engineering firm KPIT Technologies nosedived last Monday after JP Morgan initiated coverage with an underweight rating. You would have heard analysts saying that they are overweight or underweight on any stock. But exactly what do they mean? We explain it in our Decoded segment. Among the many reasons why an equity stock could see significant reaction from investors is the rating that an investment analyst or advisor gives on the script. Rating reflects the company's overall financial health. Analysts go through financial statements and conference calls of listed companies to arrive at suitable stock ratings. The most commonly used rating system is the three-tier system with underweight, overweight, and equal weight ratings. An underweight rating on a particular stock is often followed by the selling of the said security, while an overweight call triggers buying. Other names like outperform and underperform are also used in lieu of the two. But why does this happen? Let's understand. Earlier this month, shares of Paytm surged up to 18% on the day global brokerage Macquarie gave a double upgrade to the script, upgrading it to outperform from underperform. It also raised the target price by 80% to 800 rupees. The once bearish brokerages changed stance came as Paytm reported core EBITDA profitability in the December quarter. The outperform stance triggered a sharp rally as the rating signifies that the company's stock price should perform better in the future. Remember, stock ratings are performance indicators, which are given in comparison to a predefined benchmark. Hence, in an analyst's opinion, an overweight rating on a Nifty 50 stock could mean that it could outperform the average returns of the Nifty benchmark. It could also mean that the security may be a better performer than other stocks belonging to the same sector and thus deserves more weightage in one's portfolio. Similarly, a portfolio manager may recommend increasing allocation to a particular sector or even an asset class if it is expected to perform better than the other portfolio constituents. On the other hand, an underweight rating is where a security is expected to underperform the benchmark against which it is being compared. Moreover, if a stock has been given an underweight call, it could also be a signal for investors to prune their holding in the counter or avoid buying it altogether. Meanwhile, an equal weight rating falls between the two, which means the analyst expects a stock with this rating to perform in line with the given benchmark. Within a portfolio or an index, it simply means giving the same importance to each stock. Overall, stock ratings are widely tracked guides to help investors decide their investment rationale. Although different stock ratings are all too common among analysts, investors thus should prudently aim to back their investment decision with independent research.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But financial analysts are often criticized for not providing specific guidance on how much of the stock, which they brand overweight, should be purchased by investors. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.